If you're within 10 years of retirement and have $1 million or more sitting in a traditional 401k or IRA, this video could save you on your lifetime taxes. The question we need to answer today is straightforward but widely misunderstood. Is your Social Security income taxed? The short answer is yes. Up to 85% of your benefits can be subject to federal income tax. But before you panic, let's clear up the single biggest myth in retirement planning. When the IRS says up to 85% of your benefits are taxable, it does not mean that the government is taking 85% of your check. It means that 85 cents of every dollar you receive from Social Security is thrown into the pool of ordinary income that gets taxed at your regular marginal tax bracket. But here is where it gets dangerous. Because of the unique way that the IRS calculates this tax, many middle-class retirees run directly into a phenomenon known as a tax torpedo. And this is where a single extra dollar withdrawn from your traditional retirement account can suddenly trigger taxes on your Social Security, causing your true effective marginal tax rate to actually skyrocket. And stick with me, because at the end of the video, I'm going to show you a counterintuitive strategy. I will show you exactly why paying more tax to the IRS right now can actually save you from even higher Social Security and ordinary income taxes later. But first, my name is Andrew Matz. I'm a financial planner at Oak Road Wealth Management, and we specialize in helping pre-retirees and retirees with $1 to $2 million saved for retirement create a confident retirement plan. Now, to understand how to fix this problem, we first have to look at the math behind how the IRS tracks you. The IRS does not just look at your standard adjusted gross income to determine if your benefits are taxed. They calculate a specific metric called provisional income. So to find yours, you take your standard adjusted gross income, which includes things like ordinary wages, capital gains, and traditional IRA or 401k withdrawals. Then you add back any tax-exempt interest like municipal bond distributions, if you have any. And then finally, you add exactly half of your total annual Social Security benefits. And that final number determines exactly how much of your benefit is exposed to Uncle Sam. And here is where the real trap springs. Look closely at those numbers. If you are a married couple filing jointly and your provisional income crosses a mere $44,000, up to 85% of your Social Security benefits becomes taxable ordinary income. And here's the issue. These thresholds were enacted in 1983 for the 50% tier and 1993 for the 85%. Congress chose not to index these thresholds for inflation. So think about that. In 1983, 32 grand was comfortable. Today, it barely covers basic living expenses. Because the rules are set in stone, what started as a tax aimed strictly at the wealthiest Americans has turned into a tax drag on almost every retiree who managed to save a modest nest egg. So if your nest egg is parked entirely in traditional pre-tax 401k or IRA accounts, you have a ticking tax time bomb. Why? Because every single dollar you withdraw to buy groceries or pay your mortgage increases your AGI, which pushes your provisional income higher and triggers more tax on your Social Security. So how do we soften this trap? There are two primary levers that we look to deploy. First, let's look at strategic tool number one, the Roth conversion window. This brings us back to that counterintuitive strategy that I promised you earlier. The optimal time to manage this tax is during the gap years. This is the window between the day you retire and the day that you are legally forced to take required minimum distributions or RMDs, or choose to claim Social Security. So during these gap years, your structural income, it drops significantly. If you proactively convert a portion of your traditional pre-tax retirement funds into a Roth IRA, you voluntarily pay tax on that money today. Yes, you are choosing to write a check to the IRS now, but look at what happens down the road. Once that money is inside the Roth IRA, it grows completely tax-free. And more importantly, qualified distributions from a Roth IRA do not count towards your adjusted gross income or your provisional income formula. By systematically moving money out of pre-tax accounts ahead of time, you keep your future provisional income low. This effectively creates a permanent shield around your Social Security check. So now, what if you are already over age 70 and a half and you want to support a charitable cause? That is where we leverage Qualified Charitable Distributions, or QCDs. Normally, when you hit your mid-70s, the IRS forces you to take an RMD out of your pre-tax accounts, which drives up your provisional income and it taxes your Social Security. With a QCD, you can instruct your IRA custodian to send up to $111,000 per year directly to a qualified 501c3 charity. And because that money goes directly to the charity without hitting your bank account, it never shows up on your AGI or your provisional income formula. You fulfill charitable goals, satisfy your RMD, and keep your Social Security tax exposure to a minimum. But I need to give you a dose of reality that you won't hear on most sensationalized financial videos. For a significant portion of you watching this, paying taxes on up to 85% of your Social Security is going to be completely unavoidable, and that's perfectly okay. If you have built a substantial retirement portfolio, say $1.5 million or more, and your investments generate strong dividends, capital gains, and natural income, then your baseline provisional income is naturally going to sit far above the ultra-low $44,000 threshold. I like to remind people, the goal of retirement planning is not to pay $0 in taxes. The goal is to maximize your total net cash flow over your entire lifetime. If you artificially suppress your standard of living or make poor investment choices just to save a few pennies on your Social Security tax, then you're totally missing the point. Sometimes paying the tax means that you won the game. It means you are highly successful, well-funded, and secure. Navigating these rules requires balancing multiple moving parts simultaneously. If you would like professional guidance, please click the link in the description below to schedule an introductory call with us. But otherwise, thank you for watching. Please like and subscribe, and make sure to keep your eye out for the next video.